You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back to the podcast. Today we're going to be talking about how to build generational wealth by employing your children in your business or your rental property. Paying your kids to work in your business is a great way to encourage hard work ethic, build generational wealth, and get a tax deduction at the same time. This is also a great way to save thousands of dollars in taxes over time, as well as set your child up for millionaire status. So let's get into it. First off, is it legal to hire your children to work in your business? And according to the Fair Labor Standards Act, it is. So you are able to hire a child under the age of 18 as long as the business is owned and operated by the parent or legal guardian. I want to preface this episode by saying you have to be reasonable, right? You cannot hire your child for $50, $60 an hour and have them do yard work or filing papers. It has to be reasonable compensation, right? Maybe $10, $12, $15 an hour for them to do various tasks. One of the litmus tests that I like to use is picture your neighbor's child and how much would you pay your neighbor's child to work in your business or your rental property. If you wouldn't pay them that amount, then do not pay your own child that amount. So that's a pretty good test, a factor to see what your child can do. As far as some of the activities that they might do in your rental property or business, they could do property management. Maybe they're running your social media accounts. They could do landscaping maintenance. Maybe they do some cleaning, maybe some data entry, all different types of activities that your child can do in your business and get paid for at the same time. One thing I will say for my people who are owning rental properties and trying to qualify for material participation, keep in mind that any sort of hours that your child works, those are going to be less hours that you're going to be able to use in order to qualify for material participation. So just keep that in mind when you're scoping work for your child to do. So let's talk about it, right? The tax savings up front. This is a great strategy. When you employ your child, let's say you were to pay them $12,950 a year, which happens to be the standard deduction amount for 2022. Basically, somebody can make up to $12,950 and not have to pay any taxes on that. The child is also exempt from Social Security and FUTA taxes. The $12,950 standard deduction means they don't have to pay any federal income tax. Now, some states may vary, so make sure you check with your state on that. Assuming you are in a 22% tax bracket, if I'm able to pay my child $12,950 a year to work in the business, I'm saving $2,849 by paying them the max $12,950. If I was in a 37% tax bracket, I would save $4,792. So essentially what you're doing is you take that deduction from your business bank account, you're paying your child, you're going to get a write-off in your business, and your child, and this is important, your child is going to receive that money tax-free. Why? Because that amount is less than the standard deduction amount. So pretty cool. So you get this write-off that you're able to get a tax deduction for, which there's a monetary value there. We just calculated that. It's doing the deduction times your tax rate. The child can recognize the income tax-free. And think about how much that $2,800 or that $4,700 could be if you take the tax savings and let it grow and reinvest it in your business, or maybe you reinvest it in other businesses, right? So tax savings up front, pretty cool. You get a tax deduction for it, and your child gets to recognize the income tax-free. But this is the cool part. This is awesome. Because your child has earned income, they are now able to contribute to a retirement account, and particularly a Roth IRA account is the one that I like to recommend the most. And a Roth IRA is a great savings vehicle because the money goes into the account, in this scenario, tax-free. When normally, if they were making more money or they were not your child, they would have to pay taxes when they put the money in the Roth account. In this scenario, they're making tax-free Roth contributions because they're below that standard deduction amount. So the money will go in the account tax-free, and the money can be taken out potentially tax and penalty free. So here's the possibilities of what they can actually do with the money. They can use $10,000 of earnings from that account, tax and penalty free, for the purchase of their own house. And we're going to come back to this one a little bit. The contributions to the account can be withdrawn tax and penalty free for any reason at any time. Thus, the contributions to that account, they can use it to help fund maybe a business down the road, or if they're traveling, or when they go to school, they could take money out of that account to fund their college. The earnings can be taken out too, but just not tax and penalty free. Another way to use the account would be for qualified education expenses. If they go to college, such expenses are exempt from that 10% early withdrawal penalty. However, they will have to pay income tax on the portion that's withdrawn from earnings. Or they can just simply use the Roth IRA as a jumpstart to retirement savings. If you contributed $6,000 to that account for 11 years, let's say you start your child off at age 7 to 18, they have a Roth IRA and you can earn an 8% return, that account would have a total balance of $99,873 after those 11 years. It would be a total of $66,000 in contributions and $33,000 in earnings. Not a bad start for an 18-year-old. Assuming they took the same $6,000 per year at an 8% return until the age of 65, so they continued those good habits, the work ethic, the good habits, that account will amass to $6.4 million and a total contributions of $348,000. So talk about building generational wealth in your family through employing your business, through employing your children in your business. The business is going to get a tax deduction for it. Your child is going to recognize it tax-free, and you're going to be able to have your child contribute to a Roth IRA account. So what are some potential downsides to employing your children? You will have to typically have a payroll company issue them a W-2, so you might pay an extra $300 or $400 a year in processing fees to make that happen. In some states, you're going to have to pay workers' compensation on your child's wages. You're going to have to comply with federal and local labor laws in your state. We talked about before that the hours that your child works is going to take away from your time for material participation. So if you're close on tracking material participation hours and you need those hours, it may not be worthwhile to hire your child in your business. One of the things I wanted to circle back on and to highlight this pretty cool key strategy is you pay your child through your business is going to get a tax deduction for it. The child's going to recognize the income completely tax-free, allows them to open up a Roth IRA account. Again, pay no taxes to put the money in. The money is going to earn and grow tax-free. And as long as they have the account for at least 5 years between when they start contributing to it and when they take money out, they're able to take up to $10,000 worth of earnings completely tax-free. So a cool strategy that I had thought of is, if let's say I hired my son from ages 17 to 21 to have him work in my business, and I was to pay him $6,000 a year to work, I would be receiving a tax deduction of 6,000 times whatever my marginal tax rate is at the time for those 5 years from 17 to 21. But then he would be able to contribute that $6,000 to his Roth IRA account because he now has earned income. And let's say if he contributes $6,000 a year for 5 years, let's just say that's going to amount to $30,000 in total contributions. But maybe that $30,000 grows to $40,000 over those 5 years. And that 5-year rule is the magic number because once you have the account for 5 years, you're able to withdraw up to $10,000 of earnings tax-free for the purchase of a first-time home, a primary residence. So in this scenario, he could use that $40,000 in his Roth IRA account, the $30,000 of contributions, and the $10,000 of earnings to fund his first house hack. So he'd be able to put a down payment plus closing costs on a property and do it completely tax-free, right? Because we created the deduction from the business to the child. That was tax-free. The business got a tax deduction for it. The child was able to recognize the income tax-free. didn't have to pay taxes on it, was able to use it to fund a Roth IRA account that was going to earn and grow tax-free. And after 5 years, they're able to pull the money out of the account with the earnings, tax and penalty free, to fund their first time home. Maybe it's a duplex or a quad, a house hack. How cool of a strategy that is to be able to set your child up to buy their first rental property for free. That is completely tax free. That sounds like a very cool strategy, and something that I'd be looking to implement with some of my clients, as well as children of my own in the future. Thanks for tuning in to today's episode. We talked about a lot. We talked about the tax deductions on the front end. We talked about the child not having to recognize the income. We talked about being able to contribute to a Roth IRA account and what they could potentially do with that money, whether it's they want to go to school, they might want to just use it to early start their retirement savings, or if you're financially savvy, they will take that money and turn it into a rental property. If you enjoyed the show, make sure you leave a review on either Apple or Spotify. And let me know what you want to see in the next show. You can hit me up on Instagram or Twitter at LearnLikeACPA, and I'll see you guys in the next episode.